Hi, everybody. Arnold Shuchat here, Sutton Group West Coast Realty. Today, in this very short and fast-talking video, because I only have 5 minutes, I'm going to give you an idea of some strategy for those seeking to downsize based on retirement or the like. The first thing I want to tell you is what's going on in the market. Up here, I have Richmond, North Vancouver, Vancouver, and Burnaby, each one represented by a different line. These are the housing price indexes as represented by prices for average type houses throughout the years, the last 5 years. And you could see, no matter what you're hearing in the media, that although it was high last year, the price decline has not been as significant. So for example, this one is Vancouver. It went from 2.627. Now it's at it's 2.380. And Richmond from a very high of 2.196, and now it's 2.108. That might be less than 100,000. Now it's significant, but it's not that significant, and it's on the way up. The other thing I want to show you is inventory. Inventory for all these areas, it's sort of gradually on the way down. And days on the market, most appraisals would tell you if it's 3 to 6 months, it's average. We're still looking at 22, 7, 13 days. That's nothing. That's time to write a contract, do your due diligence, and close a deal. And finally, on the sales to active ratio, where maybe 17 to 20% of sales to what's active would represent an average market. We're above that, with in some case with North Vancouver being 0.37. That's multiple offer territory, and this is definitely still in seller territory. So things are not that bad. They're way better than what's portrayed in the media. And with that, I wanted to take you to what's going on in the economy. Quickly speaking, you can see that consumer loans as of March 29th, chartered bank rate was 12%. Now, just remember a year and a half ago. So if you want to compare selling your house today to a year and a half ago, you might take 100,000 less on your house. But where are you going to put your money when you get it? Mortgage rates were 3% last year. What could you get as a return? That was the problem everyone was asking me. Where do I put my money if I sell? So here, what do we have? This is a 2-year benchmark of government Canada bonds, 3.75. Going out to 3 years, it's lower. 4 years, it's lower. 5 years, it's lower than that. That's called an inverted yield curve, where you have an inverted yield curve and the yields are lower going further out. What you've basically got is an expectation of a short-term recession or negative economic growth. And that's telling you. And so if the housing prices haven't hit yet, and we obviously have to compare that against immigration and direct housing pressures, because we know there is a squeeze. What we have is a problem, an expectation that there's going to be less market activity. People might not buy as many cars. They might sit back. They're hearing about a recession. Just hold on to our money. Let's not renovate. And everything contracts. It becomes self-fulfilling. So, but there's a silver lining here, because where will you put your money when you sell your house? Suppose you sell it for $2 million and you buy a two bedroom for 1.4, and you have 600,000 leaving out transactions costs. Well, last year, what could you get for your 600? People didn't know what to do with their money. The rates of return were quite low. This year, if somebody put that into a mortgage investment corporation, that's like mortgage money backed by first mortgages and sometimes first and seconds, you can get anywhere from 9 to 11%. Now, if you think about that 600,000 surplus that you don't have to put in a house anymore, and you're getting 10 to 11%, somewhere between 60 to 66,000 a year, split between you and your spouse for tax purposes, that's far better than what you would have had last year. And that's enough to make people think they might be able to pull it off. So from a timing standpoint, we are better this year. Just as in the market, when you're concerned about where your stocks are going to go, and people there's been enough of a rise, they might sell their shares and buy fixed debt instruments to take some of the risk out. You might do the same thing with a house. Assuming you're in the headspace that you're ready to go, it's time to go, you're both healthy. Why would you wait till one person's sick or incapacitated? This is a really good time to consider downsizing for all of the reasons I just gave you. That's my wrap up for today. Thanks for listening in. And any questions, you know where to call.